Globally, equities have witnessed significant volatility in the last couple of years. We saw a major down cycle event due to COVID-19, with markets correcting 29% in March 2020, followed by a sharp rally where equities bounced back swiftly to touch all-time high around start of 2022. And recently, again, markets felt the jitters as tension between Russia and Ukraine escalated to war. This shifted investor sentiment globally. As a result, global equities saw a drawdown, that is a fall from peak to trough of around 15%. Indian equities also took the brunt to a further upswing in commodity prices, particularly oil and industrial metals, unexpected off-cycle policy rate hike by the Reserve Bank, and concerns around the derating of high earnings expectations, leading to a risk-averse sentiment. Our view on Indian equities is based on 4 pillars. First, absolute valuation. Second, relative valuation. Third, contrarian indicators. And fourth, fundamental risk. Absolute valuation for Indian equities compares our 10-year valuation-adjusted return estimate to a fair return estimate, suggesting whether the markets are over or undervalued to a fair return. Where fair return is the return that markets are expected to generate if they are trading at a valuation multiple that is close to its fair value and would purely be driven by dividend and share repurchase yield, earnings growth, and inflation. The current return estimate stacks unfavorably versus the fair return as market valuation seems stretched, particularly for large and small cap equities. Post the recent correction, market valuation saw some improvement with 12-month forward price to earning multiple at around 19 times, now converging to its long-term average of around 18.4 times, although still indicating a slight premium. However, when we look at the trailing 12 months price to earning multiple and compare it to the fair PE for Indian equities, the valuation still indicates a premium of 30%. Our valuation implied return framework factors high long-term margin and return on equity estimate as compared to the current levels, indicating a positive reversion impact on the return expectations. Put simply, profit margins and ROEs, as they revert to their long-term estimates, it would improve the return estimates. The relative valuation pillar helps to understand whether the market is over or undervalued relative to other markets as part of the opportunity set. On this front, Indian equities rank low relative to Europe and emerging markets and ranks above US equities. Contrarian indicators helps us to evaluate market sentiment. That is there too much optimism or pessimism prevailing in the market? We evaluate sentiment by tracking 3 contrarian indicators. First, momentum, which tracks short-term market performance. 2, flows, which tracks foreign fund flows. And 3, expectations, which track short-term consensus earnings estimates. At an aggregate level, all 3 indicators combined have slightly improved recently and are close to neutral levels, and not indicating an excessively bullish or bearish sentiment at present. The fundamental risk assessment for Indian corporates seems stable with low or favorable financial leverage, operating leverage, and revenue cyclicality. Although some contingent events mentioned earlier, clubbed with unknown factors, can pose as risk to our base case assumption. Overall, we believe some of the supporting factors such as fiscal reforms, thrust on capex, improving private consumption, export growth, and corporate deleveraging bode well for the Indian corporates over the long term. Although many of these positives appear to be priced in the current market valuations. With the recent correction, markets have now started to price in some of the risk factors. Equities would continue to remain volatile in the near term. The ongoing geopolitical tension could impact global growth recovery and have a spillover impact on India. This, clubbed with supply-side disruption, a reversal in major central banks' monetary policy, and elevated commodity prices, still pose near-term downside risk to equities.